On today's hot sheet, I will be talking about housing inventory, the U.S. housing market value, as well as what else do we got here? Rental market concessions. I am Byron Lazine. Today is Monday, August the 12th, 2024, and the hot sheet starts now. Welcome into the hot sheet. Let me know in the live chat which market you are tuning in from. I hope everybody had a great weekend. And I hope real estate agents are ready for what is to come the end of this week. Friday is the 16th, which means Saturday is the 17th. Many MLSs around the country will have already implemented by Saturday, or on this Friday will be implementing the changes per the NAR settlement. Agents that have been preparing for the last 2 or 3 months are ready for this moment. And those that are not really need to get a plan here the next few days. Don't overthink it. Agents that are closing the knowledge gap, that are being an agent of change in an ever-changing world, are going to be fine. I wouldn't worry about it, quite frankly, at all if you're one of those agents and you've been tapping into the resources like this show. All right, let's get into the inventory as we do every single Monday. Inventory is the best thing that can happen to the housing market. Gets us out of this, acceleration of prices that are just too big to really make sense of, too big to keep going forever. Brings normalcy to the market. The more we can get inventory and get back to potentially a normal market. Okay. So let's just take a look, as we do every single Monday, at the first 2 weeks or the last week here on inventory. We're at 41% more inventory than we were last year. And we are in a new studio here. So there are some things that just might not be as fluid today as normal. New Naples, Florida studio. We are working out the kinks. Literally, Bobby is coming in tonight to figure this out. And there we go. We're not able to see the screen. Hold on here. I'd love to show you the screen. 41% inventory more this week than same time last year. I'd love to show you that difference, how much above 2020 we are, according to Altos Research, and when we might catch pre-pandemic levels. Here we go. Here's that chart. Okay, so 41% more than last year. As you can see, 2018, 2019 at this time, we're at 965,000. While right now we're at 692,000, about to break 700,000 for the first time in literally seems like forever. Remember, 2020, we started with 763,000. So we may be approaching that number here before the end of the year. It's what I'm very hopeful that we will be able to do. And we'll see if we can continue to get these types of gains. 9,000 last week. Week before, we were at 6,400. And 2 weeks ago, we were at 9,000. So we're getting healthy gains here on inventory, active inventory nationally. That needs to continue at a time when, if you look historically in normal markets, we get pretty flat right here. Okay. And then you see the active inventory really start to decline. We haven't flattened out yet. Okay. We've still been on the increase. This is the time of year where you would expect normal, based off a normal year, pre-pandemic years. The last 3-4 years have been anything but normal. 2020 was declining already at this point, obviously. The last 2 years, we continued to see an increase. With where rates are, I'd expect us to model 22 and 23 a little bit closer than the flattening and deceleration that we saw in 17, 18, and 19. Now, that being said, as we get closer to November, that seasonality decline in active inventory should pick up as people anticipate, what do I do for the election? Maybe I just pull my house off the market. Maybe I regroup. Maybe I go out in the spring. These are all going to be conversations people are going to have with their real estate professional, and decisions that they're going to have to make for them. Okay. Purchase applications, of course, that data is still down here as we start the week. It's been down at every data point for this year, and well below 2022. So the demand is currently just at a very low point, and that's based off of affordability. Prices, we need more inventory to stabilize prices. We also need those rates to come down, but we can't control that as much. We saw that last week after we get a Monday sell-off, we get low rates Monday, they start to pop almost immediately back up over 6.5%. Not that 6.5%, it isn't a improvement from sevens and 7.25% and 7.5%, but it isn't the 6.25% and almost getting down to the sixes that many believed. Even the CME group is starting to waffle a little bit. I don't think it's like the commenter we had here last week, and I forget who. I apologize for your names. I know we saved the screenshot from the hot sheet commenter that said, "Hey, we're going to see no interest rate cut from the Fed in their September meeting." That would amaze me. The CMA group is, by the way, still at 100% chance, but they are starting to, come back to just 0.25% as opposed to they were at 80% of it being a half a point. Now it's only 48.5% and at a half a point and 51.5% at a 0.25 point. So it's like a coin flip. Is it going to be a 0.25 point? Is it going to be a half point? That's swung from 80-20. And that's just in the last few days. So are they now swinging and maybe going to ease off their 100% prediction of a rate cut ease? I don't know. It's an interesting data point that right now, with what's happened the last week, we're seeing a change even from them. We're not seeing as much confidence in a half a point cut. There's still 100% confidence coming from CME that we will see a rate cut. Remains to be seen, of course. Okay. All right, there you go. There's your update on inventory. Obviously, what can impact inventory the most is getting affordability figured out, as some of those sellers who have been on the sidelines, who are would-be buyers, but they're on the sidelines almost because of their buyer positioning there, are going to not come on the market until they see that affordability. One of the reasons why affordability is where it is the U.S. housing market has neared a $50 trillion value in a number of trillion-dollar metros is doubling. Okay, so here's the total worth of the U.S. Real estate right now, according to this Redfin. We're at 49.6 trillion, highest ever recorded total worth of U.S. real estate. This is all residential, so this doesn't even include all of the commercial real estate, which would be higher on the bank balance sheets than they would be in reality. That's a bank problem. Chuck says it was Jeff. Yes, it was Jeff. Bobby's got the screenshot, Jeff, for Jeff. We're gonna definitely do a recall there in September, see what happens. That would be amazing if Jeff. Now I'm not rooting for that, but I'm just saying it would be astonishing if Jeff nailed that. That'd be something else. Okay. So total worth of U.S. real estate now nearing $50 trillion. Real estate, no matter what happens here at the end of this week, a lot of changes in the real estate industry. Real estate's not going away. People who need advice on real estate and want an expert in the corner, not going away. All of these things are going to be part of the fabric of this country for many, many decades, and just as they have been. The value of America's housing market will likely cross 50 trillion over the next 12 months. This is according to Redfin economics team. Mortgage rates have started falling, but many potential sellers and buyers are waiting to make a move, meaning we are likely to continue to see a pattern where prices will slowly tick up. So Redfin's take here is that prices are going to continue to tick up here over the short term. Here are the metros with the fastest growing home total, according to Redfin. You've got Jersey topping the list in the top two, New Brunswick and Newark. Year-over-year growth over 13% in those two locations. Anaheim coming in at number 3, over 12%. New Haven, Connecticut, just at about 12%. These are the metros again. Charleston, South Carolina, at about 12%. That's your top 5. Then you've got Bridgeport Metro, which includes most of Fairfield County, the way Redfin cuts it up, at 11.3%. San Jose at 11.2%. Hartford Metro at 10.8%. Camden, New Jersey at 10.4%. Albany, New York at 10.2%. Okay. The point here is look at the Northeast, just completely littered all over this list, and then you've got a little bit of California mixed in, and then Charleston, South Carolina. That's it, right? You've got 4, 5, 7, 70% of the metros' fastest growing total home value. 70% of the top 10 is in the Northeast, where inventory is the lowest. So what we've seen here in areas like this area right here, Cape Coral, is one of the areas just north of where I'm sitting. I think that's Cape Coral is about 45 minutes north of Naples, depending on where you want to go in Cape Coral. It was the only metro to record a fall in total home value, dropping 1.6% to $204 billion. Why? Northport, Florida, it grew slower. New Orleans grew slower. Austin grew slower. Fort Worth, Texas grew slower. Why are those areas growing slower when they've been areas that over the last 5, 6, 7, even before the pandemic, were very popular for migration? It's because of an abundance of inventory now hitting the market. Okay, Florida is hitting the highest level of inventory matching 7 years ago. Okay, this is higher than pre-pandemic levels. And so when you see that, and when that settles in, and when sellers have to face that reality, when they have to really come to grips with that, that's where you see prices not accelerating up. Certainly not these 13, 12, 11, and 10% rips that you're seeing in the Northeast, that you're seeing in parts of California, like San Jose and Anaheim, and also Charleston. The top 10 here, all over 10% on home price growth. Well, you also have those areas of the country have very little inventory. They haven't caught up on the inventory like the Sunbelt states have. Okay. And when you get inventory onto the market, there's a period of time, 6, 9 months, where you don't see anything really happen with prices. But the longer that sits, the longer it weighs on a market, the greater impact it will have on pricing. Here are those metros with the slowest growing total home value. They all have in common one thing, and that is real inventory increases. Okay, substantial inventory increases. Honolulu, probably the outlier here with just having some other things to deal with, being obviously also a vacation destiny and all of that. But everything else on the list is dealing with rapid inventory increases. Cape Coral, New Orleans, Austin, Northport, Fort Worth, El Paso, McAllen, Houston, San Antonio, and they've been dealing with inventory increases. Look at Austin, look at Cape Coral, look at San Antonio. These are places that we've been talking about inventory now for months, and now you're really seeing that home price growth come to a really slow pace. San Antonio is still up 2.8%, even with the inventory that they have. But now you're seeing it impact to the negative, like at Cape Coral. You fast forward here 6 months through a winter, you may see more negatives, not big cliffs, 10, 20, 30%, but you may see some more negatives in some of these areas as we move through the next 6 months. Here's the $1 trillion club, the top 10 metros for home value here in the $1 trillion club. Look at that. New York, LA, Atlanta, Boston, Anaheim, Chicago, Washington, D.C., Phoenix, San Diego, and Seattle. If I'm in one of those markets, I'm saying we are in the $1 trillion club. We've made it. Subject line, sending out some data using, of course, the hot sheet show notes, which is available to every single BAMX member every single day. You can copy and paste all of this data, put it into your follow-up, into your information that you're sending out to your clients. We make it really easy for you to do just that, communicating with your database. And if you're in any of these metros, I encourage you to use this data this week to help serve them. Use code, I don't know if code HOT, is the old code still up? No, that was just one day. So use code HOT. That would be the code to use if you want to get into BAMX. Code HOT to get discount into BAMX. Every single Friday, we drop done for you content straight from these show notes as well. But if you want the extra, the show notes are released to you every single day. Okay, by urban area, here's the value of real estate. Where's the most valuable real estate? It's in suburban America, 30.1 trillion. Urban is at 10.3, and rural America is bringing up the rear there at 7.8 million. right now, according to this data from Redfin Home Value Estimates, more than 95 million properties went into this analysis. Okay, so there you go. Here's the total value of millennial-owned homes, and that has risen by 20%. Okay, so millennials now catching up to Gen X and baby boomers. Baby boomers, of course, in the clear here, up over 15 trillion, close to 20 trillion of the value. Gen X getting up to 15 trillion, but millennials are making a push, trying to close in here on $10 trillion of residential home value. They've gone up 20%. Value of homes owned by millennials rose 21.5 over year to 8.6 trillion in the first quarter of 2024. And that's nearly 4 times as fast as any other generation. So millennials cashing in on real estate, and millennials, I guess, if in that case, 4 times as fast, should be very protective of the U.S. real estate market. They should want to protect what has brought them more value quicker, I would say, than any other generation. According to this number, millennials see positive growth in home values. Look at that. The homes that the millennials own are going up faster than those that are owned by baby boomers and Gen X. Silent generation, for whatever reason, values are just, I'll move the screen so you can see it here, are for whatever reason lagging behind. The only thing I can think here is millennials are buying those family homes, those higher competitive homes, family homes, the homes that are obviously going to be, first-time home buyer homes where there's less inventory, higher competitive area. But millennials outpacing everybody on home value growth. Okay. Here's value of U.S. real estate by race. 40 million, 39.4 white, 2 trillion Hispanic, 1.4 Asian, and 1.4 Black. And so that is the value of U.S. real estate by race, according to Redfin's analytics there. Metro home value summary for June 2024. Here's just some of the other regions that stand out. Again, Austin, we've gone over Atlanta. Bakersfield's at 7.3% up. That's a big number. We did Bridgeport. Buffalo's up 9.8%. Charlotte's up 7.7%. Chicago's up 8.5%. These are, again, total home value year over year. So just pointing out some of the big ones. Columbus, Ohio up 9%. Cleveland's up 8.8%. Dayton, Ohio's up 8.6%. And you got Elgin, Illinois at 10%. That's a big number there. Grand Rapids, Michigan, 8.3%. Greensboro, North Carolina, 8.3%. We did Hartford, Lake County, 8.5%. Little Rock, Arkansas up 9.8%. Las Vegas is up 9.4%. Louisville, Kentucky up 8.1%. So these are really big numbers. I don't anticipate to see near 10% changes as we go into next year. All of those charts, if you want to use them, all of the data here is available into your hot sheet show notes for BAMX members. Use code HOT to get into BAMX. All right. Zillow has a report out, press release. This was this morning, in fact. 1/3 of property managers are offering concessions as the rental market cools. Heads up, Jay Powell. Jerome Powell, we want this information to get to you. Okay, the rental market is cooling. There isn't as many, multifamily apartment, single family unit, even rental increases as there was in the last couple of years. In fact, there are some that are declining. There's so many more new multifamily units that have been completed. More new multifamily units were completed in June than in any month the past 50 years. That has a shock to a market. We've been talking about this moment now for the last really year and a half. When all of this inventory flushes out, then investors and landlords and property managers are going to have to get competitive with where they're pricing. They're going to have to offer concessions. Hey, here's 2 months. Here's, some type of flexibility in your lease. Here's some types of perk. Here's a little bit off the monthly rent, whatever the case may be, to make sure that they stay at occupancy levels. Okay, to make sure that they stay high occupancy levels, because these are new. You can't have a new project, suffering. Okay, and so that's going to bring those markets overall down, because it's going to be a competitive situation. This is good for the fight against inflation. This is good for the case that the CME is making, that the Fed should cut the rate in September at their next meeting. More than half of rentals offering a concession. More than half of rentals are offering a concession in these places: Raleigh, Charlotte, Atlanta, Salt Lake City, Nashville, and Austin. The rent vacancy held steady at 6.6%. The last time higher share of rentals sat emptier was winter of 2021. Okay. The share of rental listings on Zillow offering a concession, free weeks of rent or free parking or whatever, blah, 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 all those incentives, combined to 33.2% in July. All right. It was 33 in June, and it was only 25.4 a year earlier. So this is something we've called for a while. I expect this to continue. There's more inventory coming online. They're saying July was June rather, units completed were the highest that we've ever seen in 50 years. Expect that number to continue to grow here as we work through all this inventory, where these projects started. Remember, these projects started back when interest rates were like 2.5%, 3% interest rates. And now a lot of times when they finish these projects, they have to refi them. Okay. And so multifamily's in a spot where, I'm not saying there's trouble there, but they have to get occupancy. Okay. And there is a market value for that. You're starting to see pushback. You can't just keep going up on prices. Not everybody can afford $4,000 a month. Not everybody can afford $3,500 a month. Yes, over time, rental prices always go up. You can kind of set your watch to that. But in the short term, I do expect them, especially in these areas where they've overbuilt on multifamily, for these numbers to come down. You can say, hey, that's a good thing. Hey, it's bringing costs down by bringing in more supply. Absolutely. More. That's what we're just talking about at the top of the show. More supply, more inventory. I just want to see it on for purchase properties more than rentals. I know Jerome Powell doesn't care if people own homes or not, but I do. I know what it does for somebody's stability and somebody's generational wealth. We just looked at the chart there from Redfin, the disparity on, by race, who owns all the, or what the value of the real estate rather is worth in that chart, right? We need more people owning homes as opposed to renting homes. And if we just keep oversupplying the rentals because it's easier and whatever the case may be, then you're going to end up finding people that say, well, my mortgage is here and the rent's here because there's so much supply in the rent. I'm going to go over and rent, and you'll just continue to see less and less homeowners. And that to me is a sad thing when I look at the future of this country and people's ability to really stabilize their expenses. Okay. 10-year is kind of found its spot here at just under 4. That's where it's been here for the better part of the last few days. 3.936 is the number right now. Last week we had an interesting 30-year fixed run. We started on Monday at 6.34, ended the week before at 6.4. On Monday with the sell-off, Japan increasing their interest rate, and all the global sell-off there that happened on Monday, there was a case to be made that, hey, maybe we get under 6.25, maybe we get into the low 6s. That was dispelled Tuesday as Japan had their biggest rebound day since 2008. We saw some tensions in the Middle East stabilize. Obviously, those are kind of heating back up again right now, but the interest rate popped back up. We saw a pretty good labor unemployment report last week, and we saw it go from 6.52 to on Thursday 6.63 before Friday ending up at 6.54. The weekly was all the way down to 6.47 on the Freddie Mac 30-year fixed weekly, and that's kind of where we're starting the day here, about 6.5 low sixes again now seem a little bit further out of reach than they did, obviously, on last Monday. A lot can change. We'll be looking at all of the economic and inflation data as this week continues, as well as just an interesting week in real estate overall, especially for agents as we all near August 17th here at the end of this week. To be an agent of change, know the macro as well as you know the micro, to continue to help consumers closing that knowledge gap. That is of value, and you will be surprised how valuable that is to consumers when tested through these changes. I in fact believe a lot of agents of change are going to be surprised that it may even go up for them. All right. Hope everybody has a great start to this Monday. Looking forward to seeing you guys back here on the hot sheet tomorrow. Bobby will be here in Naples, and we'll continue to get this studio in line and getting some of the tweaks out of it so that we can go through these shows very seamlessly. We do the show every single Monday through Thursday. The markets are open 9:30 on the East, 6:30 on the West. Appreciate all of you. If you got value out of this, please hit the thumbs up and subscribe down below to the YouTube channel. See you back here tomorrow morning. Until then, toodaloo.